Hi everyone, welcome to another honeystocks.com stock market outlook, and this one is going to be going out on the 9th of July 2022. The market has of course had a good week over the last few days. Before I switch over to my screen share and of course walk you through many of the charts that I think are very relevant, again I just want to take the opportunity to thank everybody who reached out after the work that I put out last week to social media. I know that it's helped many of you, and long may it continue. This week I am going to do something a little bit different. I think those of you that follow me every time I put out a video will know that I usually put out individual stocks, individual charts, and I do have some of that this week. But I actually want to walk you through some of the charts from my sector ETF chart book. There are many areas of the market that are rebounding from logical levels. We know that the market has fallen off a cliff over the last few months, and many of the areas have been destroyed 60-70%. Now, if we are in the game of identifying areas of potential value, and we have 60-70% drawdowns, declines, and we're not looking for opportunities there, then the question I would ask is, what are we even doing? So I think there is opportunity in a lot of these areas. Some of these areas have already rebounded massively, but there are certainly areas that I think we can take advantage of. So let's dive into some charts, but a couple of things to get out there off the bat is, one, I'm not a day trader. My time horizon is generally weeks to months. I think if you were to sit and have a beer with me, I think I would describe my style as more of a technical investor. I use technical analysis, I use fundamental analysis, but I wholeheartedly believe in risk management because I don't have the mental fortitude for sitting through 60-70% account drawdowns like I know traditional investors are, but I'm not that guy. So let's dive into some charts and let's see what the market's telling us. Now, before we get into this, please do pause the video, make sure you are comfortable with that before watching any further. Basically says, do your own due diligence, don't be silly, and don't act upon anything without your own due diligence. To give myself a little bit of credibility, I'm working my way towards my CMT. Technical analysis is something that I'm very widely known for in professional circles. I am considering going and working my way towards my CFA, but again, that's something that I'll consider over the coming months. So the markets is of course my life. The recent calls I've made, I know in this game it's very much a case of what have you done for me lately. Back on the 8th of June, I made a call on the top in energy. Back where this whole saga with the market started back in November, highlighting the failed breakout in the small caps, and given that it's a massive barometer for risk appetite with the market, it was a very obvious warning signal. Back on the 5th of January, another failed breakout in the S&P 500. My letter on the 3rd of January highlighting the likelihood of a valuation reset. And if you want to go back to 2020, on my website, front and centre, the analysis that was provided to our clients and members a week before the market crash is published on our website. And of course, it pays to be correct in this game, and it's not all about the market going up, it's about understanding when the market is potentially going to go down as well, and that's something that I obviously stay on top of. And if you get some value from this, as always, please do hit like and subscribe. It all helps with the YouTube algorithm. But I want to just quickly touch on a couple of charts with the broader market. Now, if you have just stumbled across my work for the first time, this is talking point at the moment, the yield curve. It's a great predictor of likelihood recession. Well, last week the Atlanta Fed tracker shows that the US economy is already likely in a recession. Now, the yield curve has inverted on numerous occasions. since the 70s, and it has got a very good hit rate for predicting recessions. Now, we know that stocks generally don't do too well during recessions. I think the big question on everybody's lips is, if we are going to go into a recession, how long will that likely last? I don't have the answer to that, but it does help to understand that stocks don't tend to do well during recessions for however long that recession might be. Now, Michael Burry of The Big Short fame, I'm sure most of you have seen an excellent movie. But Michael Burry has essentially been calling again over the last 10 days that the market is heading for an almighty crash. Now, the way he sees it is similar to what we've seen with two previous occasions, where we can see that the market has crashed, but then the following crash has then undercut the lows of the previous crash. We can see that happened in 68 and 73, and of course 2000, and then Michael Burry called it perfectly with the 2008 financial crisis, and he's essentially saying the same thing as it is going to happen here. Now, I absolutely have my doubts about this, but understanding that someone with the track record of Michael Burry is putting this kind of work out there, it does give some food for thought. Now, we have the 10-year Treasury note yield, which is a big talking point at the moment. Now, I'm just going to spend just a couple of minutes just walking through the broader market, because I think it helps to understand what kind of environment that we're in and whether or not it favours risk to reward, from a bullish perspective or a bearish perspective. But this has been a chart that I've been keeping an eye on, and whether or not the 10-year Treasury note would roll over. Now, we've not really seen that. It did threaten to roll over as it dipped below the 2018 highs. But what I'm looking at the moment is what happened with the US dollar index just a few weeks ago, where it did something similar. It then dipped, and then, as we know, the US dollar index has been ripping higher. Now, could the same thing happen with the 10-year Treasury note yield? Would that be a headwind for stocks? I think there's a likelihood of that. That would affect the Treasury bond ETF, TLT. Again, because they are essentially inverse correlations with one another, if we have the 10-year breaking out, then you would expect that TLT would decline with it. Now, when we look at the broader market indices, and of course we're looking at the Dow Jones Industrials, it is hanging on at the moment. Now, I do like to pay attention to historic levels. We tend to get rebounds technically from these levels. There is nothing fancy about my work, as most of you already know. I like to keep things simple, basic support and resistance, a couple of technical tools I like to use, just RSI to gauge momentum, volatility for options, volume, and of course relative strength. But we're looking at a big level for the Dow, and at the moment it's holding up okay at the moment. And when we pull back in the major averages to these levels, the risk to reward proposition then starts to favour some bullish positions. Now, we have seen some massive moves over the last few weeks. Now, we've got the Russell 2000 again holding on to these COVID crash levels. Now, the other thing to say is, if the small caps fall off a cliff at these levels, you would probably expect the Dow to follow suit. Like I touched on at the start of the presentation, the Russell 2000 is a very good gauge of risk appetite within the market. And I think that the question everybody has at the moment is, are we just going through a textbook bear market rally, or are we looking at something a little bit more meaningful to the upside? Now, something I learned from the 2000 crash is to not get married and attached to any particular thesis. My message to our clients over the last few months is really just to treat every chart on its individual merits. Yes, of course, if we start to see breakdowns in the Russell 2000 and the Dow, then that is a big problem. The triple Qs, of course, technology. I'm sure many of you are looking to take buy positions in technology, is holding up at the moment. And again, the message I've been putting to our clients, our members, over the last few weeks is this is actually reaching a buy point where you can start, in my opinion, to test some waters. We can see that historically, over the last 15 years, that it has been a decent spot. Now, we of course know that 2008 we got the rally and then ultimately it collapsed. We could absolutely see the same thing again, but this is where, of course, risk management comes to the fore. Now, there's a lot of talk about China at the moment. Now, my work has got a lot of attention over the last few weeks, and China has been a part of that. Now, if we look at something like Chinese internet, we can see that from peak to trough, we've looked at an 80% decline. Now, this is what I was talking about at the start, where if we are not in the business of looking at positions that have declined already 80%, then what are we really doing as investors? And when we see things like capitulation, and for me, this is what textbook capitulation looks like, you just get an absolutely accelerated decline and then a monster rebound. That tells us that there's a meaningful bottom that's starting to form. Now, I'm looking at the Chinese internet. If we can get a breakout above this, $35 level, then I think a lot of the names aligned with Chinese internet, the JDs, the Baidus, the Alibabas, that's what the Alibaba chart looks like. We reached an overbought condition just a couple of weeks ago, and it does start to look very interesting to me. Of course, we've got emerging markets holding on to key support levels. Again, this is one of the charts from our ETF chart book. And again, looking at lower end support levels with bullish divergences, they don't always indicate bottoms. That's something that I just want to highlight. So if you are interested in these types of positions, for me, it makes a lot of sense to just have risk management in place and kind of have stop losses below these critical levels. We've got the XLK ETF holding on to historic levels. So this isn't any coincidence to me. Again, Apple, Microsoft, Nvidia, these are all stocks that are aligned with XLK. So if XLK is going to hold on to these support levels and you've got the triple Qs holding on, then again, it might be a favourable risk to reward proposition for some of the technology names. And of course, Microsoft. I've been banging the drum on this chart for a few weeks now, and it's still continuing to hold up. We've got industrials. I posted this chart to Twitter the other day, just highlighting that this is a big level for industrials. Again, notable holdings: Caterpillar, Deere, Boeing. If XLI is going to hold on to these levels, then you would expect some of these names to go with it. But of course, we are coming up to earnings season, and I think the question on everybody's lips at the moment is, what does earnings season ultimately look like? I can't imagine it's going to be an earnings season that delivers. I am fully expecting some numbers to be on the low side, but it's all about market expectations. The market is forward looking, as we all know. So how much of the earnings is already baked into the current price? And that is the question on everybody's lips at the moment. We've got XBI, again, another one of the charts from our ETF chart book, has just absolutely ripped off the lows. Many of our clients and members have done very well on this. Again, notable holdings: Amgen, Vertex, VIR, Biotechs. Now, let me just say as well that this isn't one that I would be looking to jump on, after a 35% move in a couple of weeks. I'd be looking for this to kind of digest some gains, because for me in my work, I'm very much about the optimal entry and these optimal buy points. I don't feel like there's much point in chasing after moves once they've already happened. But again, if it pulls back, it might be one of those that offers opportunity. We've got healthcare, again putting in a failed breakdown a few weeks ago and has been moving steadily higher. Some notable holdings there. We've got United Healthcare, we've got AbbVie, Johnson & Johnson. A lot of those names have made very good moves over the last few weeks. Of course, we've got Eli Lilly making new all-time highs, which, believe it or not, there are stocks out there that are doing just absolutely fine at the moment. We've got financials. Again, is it a massive top, or is this a rebound level? Notable holdings, JP Morgan, Goldman Sachs, Wells Fargo. I do have my eye personally, and I shared this chart last week with our clients. With something like Wells Fargo, I think the fundamentals are pretty solid, and I think if we can break out above this $42 level, then that might be a level that we could see some moves. But given the banks will be first up with earnings season, earnings will be the catalyst either for a move higher or, of course, a move lower. We've got the leisure and entertainment ETF, obviously notable holdings there. We've got Starbucks, McDonald's, Disney. It has broken down a few weeks ago, and it seems to want lower prices at the moment. I think this is probably a good gauge on the way the current economic situation is. Inflation is moving higher. Not everybody has money to go and spend at Starbucks and McDonald's, etc. So I think it is currently a bearish position. To the other side of that, we've got Nike, obviously apparel and footwear. I like my Jordans just as much as everybody else, but we did post earnings on Nike a few weeks ago. They looked okay, in my opinion. We have a bullish divergence, and it does look like it's put in a potential failed breakdown. So again, I think this is one. Nike is absolutely not going anywhere, and I think it's a great company. And of course, if it does decide to decline further, I would look to see where it ultimately looks to settle and build some kind of base. But at the moment, I think there's a risk to reward from a bullish perspective. We've got the timber and forestry ETF, which is breaking down. It completed a 15-month top. Again, another one of the charts from our ETF chart book, and it's currently in a bearish downtrend at the moment. To the other side of things, thank you to many of you. I've covered the ARK ETF for a number of weeks now, and it did today. It's pretty much hit the upside objectives there. I wouldn't be looking to give up any gains on this. I think close management, I'm fully expecting some kind of resistance there at the $50 level. But I think what gets really interesting for me is if the ARK ETF breaks out above that $50 level, then that, in my opinion, will probably be an environment where the small caps are doing well and we are getting some kind of more sustained rally to the upside, which I think most of us would probably prefer. One of the metals and mining ETFs is XME. Now, for those of you, again, that have maybe just stumbled across my work, I called a top in metals and mining a few months ago. Rising prices, bearish divergence. Now, again, we've got lowering prices, bullish divergence. Now, whether or not this level ultimately holds up is really anybody's guess. I put out a chart to our clients last week for FreeportMcMoran, really just highlighting that we had reached a level with the RSI where we could reasonably expect a bounce. Now, if you haven't been following FreeportMcMoran, this week it had a 7 or 8% upside day, I think, on Wednesday, maybe Thursday, and it did incredibly well. But for me, it now has to prove itself and get back up above that $30 level. I think if we can get above that $30 level, that's probably an environment where the copper miners, the metals and mining are doing reasonably okay. Lots of questions on Bitcoin. I do cover Bitcoin and cryptocurrencies, although I am starting to come to the realization, I guess, that most of them are scams. So the only two that I really cover nowadays are Bitcoin and Ethereum. I think it's just a lot safer. And I think that the $20,000 level here in Bitcoin is massive. We've reached a historic level with RSI where it's reasonable to expect some kind of meaningful oversold bounce at these levels. So that is certainly the hope for Bitcoin. If that happens, of course, like another example of capitulation, MicroStrategy. Now, Michael Saylor gets it. Everybody wants to just kind of stick it to him. I actually admire the man just because he has such courage in his convictions. Now, whether he's ultimately correct, I have no clue. But what I can say from a charting perspective, and let's just remove the fundamental data here. Everybody knows that nobody buys MicroStrategy for the fundamentals. It's really just a play on Bitcoin. But we had that capitulation, 74.5% decline in 6 weeks. And then it's now starting what looks to be building some kind of base. So if Bitcoin can catch a bid, don't be surprised if you see Michael Saylor posting a few funny memes to his Twitter. I always find it quite funny. We've got Amazon holding on. For those of you that picked up my YouTube analysis on Amazon a few weeks ago, just highlighting it as a buy opportunity above $100. I'll link that video at the end of this for anybody that missed it. But again, it's up 15% and the very big support level there at $100. We've got Nvidia hit new 52-week lows earlier in the week, but is rallied quite well. Certainly, it's a stock that, of course, many of us like. But I do have this sneaking suspicion that it could ultimately end up testing those levels at 115. But if this is as low as it gets, it's obviously had a monster drawdown, and for me, it's probably one of those names that you can dollar cost average on, and over time you'll be absolutely fine. Same with Chipotle. I covered this one a few weeks ago, and it's held on to the support levels as expected. Ultimately, will it continue? I don't know, but there's a very easy out if it breaks below these key levels. We've got AMD. I covered this one last week. I had a few messages thanking me on this one. Congratulations if you're watching this analysis as well. But as long as AMD is above these levels, if it starts to undercut these lows here, then again that's probably a big problem, and you'd probably find that semiconductors aren't doing too well. We've got Netflix, 205 target is still in place. We've got SOFI is starting to look interesting to me. I think if it can break out above this very stubborn 50-day simple moving average, then it could be one of those that does catch a decent bid. Of course, very, very risky in my opinion. There's not any earnings or earnings growth. It's highly speculative financial tech play. But again, if it can break out above this 50-day simple moving average, which as we can see historically has been a big problem. And we've got Zoom, again, holding up absolutely amazingly well. I called the bottom on this one a few weeks ago. Chart went out to our clients and members. and it's up 15-16% and holding on to that 10-week moving average very, very well. So there's a lot really to digest with the market at the moment. It's not easy. Certainly, the theme of the feedback that I get from our clients is that it's very much a risk-off environment where batting singles and taking the odd one or two plays here and there is the way to kind of navigate at the moment, because with the broader market, I think there's massive opportunity, and I think those that will miss the opportunity will be the ones that overtrade. They're getting eaten alive by all the intraday volatility, stop losses triggered on little 20-cent stop losses, which just don't work. So the message would be just survival at the moment, and take these little wins here and there. And when the market does bottom, there is an absolutely incredible opportunity ahead. So I hope you got some value from that. If you have just stumbled across my work, feel free to go and check out our website at honeystocks.com. We provide memberships for our work, premium weekend analysis. Every single weekend we put out our premium work to our clients and members. We provide investment trade ideas, provide our halftime report every Wednesday, provide access to a wonderful investing community, access to my chart books, includes my ETFs, and of course our technical analysis program, which is included with all memberships. So if you are somebody that would like to learn technical analysis, then you have access to what I'm told is a very good technical analysis program that I've built out. But at the moment, doing a very big 20% off summer offer. It ends this Sunday. It has been running for 7 days already. So if you are somebody that would or has been eyeing up my work for a while, there's an opportunity there to get it for a 20% discount, and you also get a 7-day risk-free trial as well. But just to quickly show you what our trade ideas look like, recently there have been quite a few short ideas. This is one for the commodity index, which was closed out this week at a good profit. We had Zillow again, another short idea. We had Box met our downside targets, was massive winner. If you want to see what bullish positions look like, this is a massive winner for Cloudflare, Antero Resources. But I am very, very unique in what I do. I publish on our website every single high conviction idea that's ever went out to our clients and members. The purposes of this is really just to show the types of stocks that I like to recommend. You can see the date that they've been recommended, the price they've been recommended, and how those stocks have ultimately gone on to perform. I've done this over the course of the last 4 years, and there is only one other investment charting service, research service that does this that I'm aware of, and they are considered to be the best on Wall Street. So feel free to go and check out my work. I think if you have a mid-term approach, I think my work would probably be a good fit. If you are looking to get away from day trading, 1000%, there's no point in signing up for my service or my work if you are somebody that is trading on 1 minute time frames and all that nonsense. I think if you are looking to learn technical analysis in a logical way without overcomplicating things, if you want to be part of a community and maybe you're just sick of hunting around social media, probably my work might be a good fit. But please do all your own due diligence. If you have stuck around to the bitter end here, thank you very much for watching, and I hope to welcome you soon. Thanks as always.